Let's talk to Marc Ostwald. He's a strategist at ADMISI. Very good morning to you, young Marc.
Very good morning.
Right, we have 3 slides.
Yes.
Let's kick off with the first one. The headline, Fed rate expectations and buy meeting.
Yes.
Obviously, we've had a meeting this week.
Yes.
Unchanged.
Unchanged. There were some interesting tweaks to the statement. They introduced or they re-emphasized this point that their CPI target is a symmetric target. And that's quite important because for the past 3 to 4 years, actually even a bit longer than that, CPI is, or rather the core PCE deflator, which is what they target in terms of an inflation measure, has been undershooting their target. By introducing symmetric into their statement, they're effectively saying, well, just as much as we didn't really respond to the disappointing pickup in inflation, so we're not going to overreact should we get the PCE deflators up to 2.5%. So that really puts us in an interesting space in terms of what the Fed's doing. And I thought the other two interesting aspects before I come to a conclusion about this were they dropped the term near term from their assessment of the risks to the outlook to the economy, which tends to suggest that looking at much longer term perspectives now, which certainly the likes of your Claudio Borio at the Bank for International Settlements, who've said central banks are far too fixated on very small movements in inflation data, is probably a welcome change. We'll have to see, obviously, and that doesn't take away from the fact that if anyone's thinking that way, that if we were to see a sharp tightening of financial conditions, which would come about if we saw a sharp drop in equity values, that they wouldn't respond. But it's just to say, as long as things are going along at the moment, we are on autopilot. They've been on autopilot since the end of 2016. And they're going to stick to autopilot. And basically, the message is, look, if inflation dips away a bit, down towards 2.5, we're not going to react. And if it gets to 2.5, we're also not going to up the pace. So the market's actually in quite a good place in terms of knowing what the Fed's going to do, barring unexpected developments. The other interesting aspect of this, of course, was as much as markets are fretting about China-US trade tensions and obviously about the Iran nuclear deal and whether Mr. Trump is going to drop his waiver, is they didn't make any mention of either of those as things. So in a certain sense, that's quite logical from the aspect of, well, what exactly is the Fed going to do about trade tensions unless they actually materialize? And what can it do thereafter? Actually, you can only wait and see what the fallout is. It could be inflationary, it might not. It really depends. It might have a huge impact on the dollar. They don't know. So best to leave it well alone for the time being and saying, look, there are a number of unknowns out there. We can't deal with them. They're not really within our remit to deal with. Therefore, we'll get on. And for the time being, things are looking good. They acknowledge the fact that, yes, Q1 data has dipped. There has been some loss of momentum. But equally, they were very optimistic on the outlook, leaving themselves not hostage to fortune in terms of the market saying, but they've mentioned that there was a slowdown in Q1. Maybe they'll only do 2 rate hikes this year. So it's plotting a very steady course. So we've got a rate hike priced in for June, and we have definitely one more rate hike priced in before the end of the year. The market's very reticent to price in a 4th rate hike for this year, and that makes good sense when one looks at that FOMC statement. However, it also basically helps to underpin the dollar, rather more from the aspect that the Fed is plotting this steady course, and on the other hand, the ECB is backing away, largely due to disappointment with inflation, and in part due to them not being sure about what happened in the Eurozone in terms of growth in Q1. Was that a weather and strike-related downturn, or was it something more significant? But the stronger dollar is something which is now starting to have a broader impact. We talked last week about how it's impacting some of the emerging market currencies. If we go to the next slide, what I've got here is the US dollar index, which is, if one looks at it in the greater scheme of things, yes, it has picked up, but relative to where we were at the end of 2016, we're still a long, long way from seeing a strong dollar. It's strengthening, but not. But it is starting to play out on emerging market bond spreads. And this is interesting because that JP Morgan emerging market bond average yield spread versus US Treasuries has now started, is well above 100 and 200-day moving averages. And so we are in this situation where emerging market issuers, above all in Asia and Latin America, who've been hefty issuers this year, are going to be looking at whether, how they're going to refinance going forward. We had a couple of large issues for Angola yesterday, one of the worst credits in the world, not quite in the Venezuela category, but they're having to pay up 9 and 10% for 10 and 30-year paper. If they'd been pricing that earlier in the year, despite their weak status in credit terms and above all in budget terms, they probably only had to pay 8. So
Right.
we're seeing a quite marked shift.
Okay.
We're also starting to see this impact on the really weakest of the emerging market, even the big players. So if we go to this third chart, this is Turkey. The Turkish lira is the white line. It's been the whipping boy in terms of emerging market currencies. But in principle, it really underlines that if you've got an economy which has a high dependency on imported oil, you've got a political backdrop which is very unstable and certainly not very savoury. And you've got a central bank being manacled by those political forces and not able to respond to what's been a dramatic rise in inflation. If we look there back in beginning of 2016, Turkish inflation was around 6%. Now, this morning, having had an improvement in recent months since it's peaked at 13% in November, it's starting to rise again, and quite clearly it's highly responsive to the Turkish lira. It's the one, I think, which one has to watch amongst the most closely, simply for the reason that we've got the elections coming up. They're unlikely to improve the fundamentals for Turkey, and the central bank is still going to be manacled from really doing what it needs to do, for instance, like Russia did some 2 years ago, in terms of responding to the inflation pressures and getting it back under control. So emerging markets are still the vulnerable spot relative on the dollar, and one can't just look at it purely in the aspect of, yes, the dollar was always ripe for a squeeze given there were so many shorts, above all against the euro. But in the longer run, it's the emerging markets that I would be most worried about, particularly if we get into a situation where trade tensions start to create a shortage of offshore dollars because of lower trade volumes, and therefore the trade surpluses which produce that surplus of dollars offshore won't be there. And that's where particularly a country like Turkey is going to be above all vulnerable.
Mark, on that note, thank you very much indeed.